Welcome to the Edition Financial Webinar, a guide to navigating market volatility. Our speakers tonight, John Stanton and Rob Mazur, are financial advisors sharing their expertise from Members Financial Services. Feel free to type your questions in the chat box and we will answer them throughout the presentation. And now I'll hand it over to John.
Good evening, everyone. Thank you so much for joining us.
Good evening, guys. This is Rob Mazur.
This is John Stanton. We appreciate you guys taking the time tonight.
And looking forward to this. Obviously, it's a little bit different world, John, than the last time we did one of these, isn't it?
Yeah, things change every day. You control what you can. My grandson loves the movie Kung Fu Panda. And one of the sayings in there is yesterday is history, tomorrow's a mystery, today's a gift. That's why they call it the present. So we sort of have to live for today and deal with what's going on today. So we're, again, so glad that you all joined to be able to listen into how to understand a bear market and sort of how it affects you personally.
Man, we're starting out with the musings of Kung Fu Panda here a minute in, isn't that? You're in for a real treat tonight, folks.
Well, I'll have to keep an eye out to see if rentals go up on it. So.
Yeah, but appreciate everybody joining us. I appreciate your time. Like I said, things are a little bit different out there. I think the last time, John, we did one of these was back in February 20th, 21st, something like that. Yep. Obviously, in the weeks in between then, the markets have changed. Things of the world as we know it has changed. I mean, it's a wonderful sunny day here in Central Florida. But I do have one prediction that I know is going to come true.
Let's hear that, Rob.
Summer's coming.
There you go.
It's one of the wonderful things here of the social distancing is I didn't even make it outside today until getting ready to come here. And I walked outside and I was like, what's that big shiny thing up there?
Right.
And second of all, man, it's hot.
Yeah. So that's Florida based for us. I mean, hey, hopefully that makes the virus go away too a little sooner with the heat coming back. We'll see.
But I got to tell you, if that prediction doesn't come true, we got big problems. So
definitely.
But no, wanted to talk a little bit about, obviously, there's been a lot of talk in the news lately of we're in a bear market, or we're in a bear market, and now we've had quite a rally off of that. But I think one of the biggest things, and it's come up in conversations with my kids, it's come up in conversations with just about everybody, is so when they say it's a bear market, we know it's bad, but what does that mean exactly?
Exactly. And looking at the slide, it really tells you the answer to that. A 20% down drop. Matter of fact, it's funny today with the trading we had going on today, the S&P actually had it back into the bull territory. Yeah. So like Rob was saying, it's been tumultuous. A lot of drops, a lot of rises coming back. A lot of uncertainty, which I think we're all in that same boat.
Yeah, and it's then you think about that in terms of the 20%. I mean, that's from peak to trough, from highest point to lowest point. In this case, just so happens our highest point was back on February 12th. If you're going off of the S&P 500, we bottomed out then that end of March, right?
Okay.
About that week of the 27th.
Yeah, we were right
I think
down
it
about
was
2,000 from 3,300 to 2,000 within that time frame.
Yeah, and of course in between then we've had, like you said, we've had actually a 20% run up again. So in technical terms, we're actually technically in a bull market again right now. Now I don't think most of us would believe that if you were to ask the person on the street, are we back in a bull market wise? But I think that is kind of also reflective of just how quickly that decline occurred. And it's one of those things that most of us have never seen in our entire lives. Obviously, there's been talk of, and let's go ahead and talk about the D word.
Depression.
Yeah,
that's a scary word.
We're not in a depression right now. This is very different from the depression. But the last time we saw a market decline like this was
2008.
The Great Depression.
Yep. I mean, the Great Recession, I think they call it, right?
Yeah, I mean, we had the Great Recession, the Great Depression. Hopefully we don't have a great anything on this one. Hopefully
hopefully a great return. No, that would be great, but we'll see.
But yeah, I mean, so our last actual bear market was back in, just like you said, back in 2008. And it's not something that doesn't happen, or it does happen very often, I should say. I mean, typically, as you can kind of see there on this slide, is we have one of these every 3.5 years. In this case, we've been what is that math on that?
10, 11 years without one. It's been pretty crazy.
Yeah, almost 12 years, something like that. That's our public school education coming
into play right there. There we go.
Right? But so it's been a long time. Now that doesn't mean that there haven't been some down markets in there. We had a down market in 2011, had a down market in 2015, actually had a down market in 2018.
Yeah, the most recent, the end of 2018, wiped out the gains for the year. So.
Yeah, and it's funny, and you use that for even context with this. Because in that fourth quarter of 2018, we went down, depending on what measure you're looking at, between 10 to 15%, somewhere in that neighborhood.
Yep.
And then everybody looks, for context's sake, look at what the returns were last year. S&P was up
30.5%.
Yeah.
Yep.
So yeah, it's been a very wild ride here as of late. But like I said, I think in context, we are in a recession.
I agree. And I think when it comes down to the reason why we're holding this webinar is for the fact of this is when emotions start creeping in. And when emotions start creeping into a logical decision or logical choices, that's when you could really see some effects. So
yeah, and that's one of the things that, like you said, we really wanted to kind of talk about this. First of all, talking in context, but I always make kind of the joke of you don't need me to tell you the news. You can look at the news. Everybody, and we have lots of time right now, so everybody's looking at the news. But we want to be able to take that and be able to put those things into practice, number one. And number two, I think take off of that and figure out kind of that, why do we make the decisions that we do sometimes? Why do we feel the way that we do sometimes? And then how do we put a better plan in place going forward off of that? I think is really the big thing to kind of look at it. And so, kind of the two things that we want to really have the takeaways, the what have we learned here today approach here. We want to understand a little bit about behavioral finance, and then looking at three keys to help weather a bear market. Because as we saw before, while we may technically be in one, not be in one right now, but this isn't going to be the last one in any of our lifetimes.
Exactly. You look back at 2008 and saw a 50% drop on average in the market. The downfall of that is anybody who sold out didn't have the opportunity to come back when it did come back. And that's sort of why we're here. It's one thing if you need your funds now, you do have to make those tough choices today. If you don't need the funds now and you do have time on your side, then obviously, being able to sit down and look at it logically of when you might need to have access, things like that is how you can sort of look going forward. Yeah.
And I think both of us in our advisory practices, we both advise going off of that long-term perspective. And that's really what we're talking about here. We're not talking about trying to, buy, calls on this and short puts on that, or, some of that more active trading, which is fine, and it's all well and good. But this is really talking about investing, about looking into a company, or into a basket of companies, finding things that make sense going forward, and make sense not just for an investment side, but also make sense in somebody's individual portfolio.
Exactly. The reason why we do in partnering with CUNA is definitely we take more of a bucket approach to it, to where we do cover the bases, to where if things like this do happen, you have other things to go to without having to worry about touching investments most times.
Yeah. So, when we talk about, behavioral finance, which is really kind of I don't want to call it a pseudoscience, and it's actually a topic that actually fascinates me. I've done a lot of reading within all this. But, back when it was really founded by a gentleman named Daniel Kahneman, and there's been several that have built off of kind of his work, but from that. But but before behavioral finance really kind of came into vogue, we looked at things and everybody basically acted off of we just thought people did the things off of three things, which is off of data, off of analyzing that data, and then maximizing your own self-interest. And it's one of the things that I've really kind of put this into my practice, is to understand kind of more how the mind works whenever making these kind of decisions. Because for me, and probably for you too, and many people who sit in our chairs, the numbers just make sense to us sometimes. Yep. And we then sometimes have to back up off of that and realize that as human beings, we always don't make rational decisions.
It's a true statement. Especially when emotions come into it. You think about things you buy emotionally. You buy a home emotionally. You buy a car emotionally. Sometimes you might go a little bit outside the budget just to have what you want. When it comes to this is definitely should be more of a logical decision. When you do allow the emotions to creep in, that's when mistakes can be made. So,
yeah, and I think looking at it from a recent context, we were just talking about, look at trying to go buy toilet paper right now.
It's true.
Has that been a rational behavior right there by so many people? I mean,
it took my family 3 weeks to find some toilet paper. I think we finally found it at Sam's one morning. So
I mean, it's almost a new currency at this point in time.
I'll tell you, it's more valuable.
And if we keep printing $2 trillion and spending bills, it might actually be worth more than $1.
Use some of that paper, maybe we might end up getting there.
But that's a different story for another day. But here's a picture of old Mr. Kahneman. Like I said, he back in 2002 actually won a Nobel Prize in economics. The funny thing is he's actually not an economist. He's actually a psychologist. Was actually born in Israel, and really kind of became the father to this whole behavioral finance movement. And really what it's talking about, and just like it says there on the slide, is it's looking at how we make those financial decisions. We're looking at that from a psychological perspective rather than from a dollars and cents, numbers on a page kind of perspective. And it's really kind of interesting stuff. And when you start to look at it, it's that, you're starting to look at people's motives and biases and how, we all have kind of different ones those that come into play. Talking about emotion. And I think that you can speak to that just as well as I can about, sometimes people, when you act out of emotion, don't always make the right decision.
Yeah, sometimes there's a lot of apologies that come from that. I mean, the biggest thing is everybody's got a perspective, and in everybody's mind, their perspective is right. But part of it is definitely trying to take the blinders off, look at things panoramically, and just get an educated, make an educated decision. Get the education before you make moves, especially on something that can be this big.
Well, yeah, especially whenever you're talking about retirement money.
Absolutely.
And that's really a lot of what we're talking about here, or just money in general. You always look at it. We've talked in the past about how you kind of rank people's assets, and obviously, I think for most people, their biggest asset is truly their earning potential.
Absolutely.
Second biggest asset is their house. Third biggest asset tends to be their retirement. Yeah. And so we're talking about one of those top three in there, and how you're making those decisions.
Well, I like the last point on this slide here when you're talking about investing. It's not about competing with others. Like you always have those people at the water cooler saying, "Oh, I got 20% this year, I got 30% this year, I did 18." It really is controlling your emotions in those times. It's not about trying to outdo somebody. It's about to sort of set your plan and stick to your guidelines and what you're trying to achieve.
Yeah, exactly. And it plays in perfectly here with our next slide in terms of making those decisions and how it affects your decisions about money. And then looking at that from, just like you just said, John, your long-term perspective, and looking at it for your personal goals there as well. And then obviously we want to talk a little bit about, two different, we like animal analogies here.
Yep.
And looking at it from the standpoint of are you an ostrich or are you a wolf? And
there's no panda there, Rob.
There's no panda. There's no racehorse. And we actually recorded a thing the other day, and you actually came up with the analogy there of a racehorse with blinders on. So we'll get to that one in a little bit. But that's where we kind of look to here. And in bear markets especially, I think the bad decisions tend to get exacerbated.
They do. And I think the one thing you really have to be focused on is when's the right time to buy, when's the right time to sell. I mean, rule of thumb, Warren Buffett, greatest investor of our time, right? People will spend $2.5–3 million to have an hour lunch with him to pick his brain that he gives away to charity. And his rule is when people get scared, I get greedy. When people get greedy, I get scared. He dumped $5 billion into Bank of America back in 2008 in the banking crisis. I think he gets a 10% dividend each year, $500 million. And what's that stock trading at today? I'm pretty sure it's much more than 5. So.
Yeah. He got so sweetheart deals there with Bank of America, with Goldman Sachs, with GE, I think is another one he struck a deal with there. And it's interesting because, again, into this current climate, he came into this Berkshire Hathaway sitting on, I can't remember what the number is, but it's some crazy hundreds of billions of dollars in cash that something tells me that coming out of this, that Mr. Buffett will probably strike a pretty good deal or two in here. But for the rest of us, 99.99999 something percent, human nature just, whenever we get into times like this, we can make some bad decisions.
Absolutely.
And that's really what we're looking at here. So some of the challenges and some of those, we can kind of categorize these into, really we've got 7 different ways that people can make these decisions that go against their long-term good, I guess is a good way to put it. And kind of looking at that and kind of starting off here, let's look at overconfidence.
Yeah, I mean, that could be somebody who just feels like they've got pretty good experience in the markets, don't need to really take the advice out there maybe, and just they really feel confident in whether they're believing in a company or thinking that we are at the bottom of our bear market, that it's time to get back in now. All those things sort of come into play. But overestimation, again, looking at your ability that you don't possess, obviously. Rob and I, we studied and got a test for this. It's just like we couldn't all be a lawyer tomorrow. We have to go get the bar exam and go through all those things. So, what it really comes down to in the end is being educated on what you may not understand, not being prideful. Don't be stubborn on thinking that you're able to handle things in a time of need. It doesn't hurt to reach out and get that advice.
Yeah, and the last point on here, that don't account for the significant role of good timing. And that's, I think I was always taught that the colloquialism there is, I'd rather be lucky than good.
Yeah, well, no, the phrase, right? It's not timing, it's time in. You got to be in the market to make the money, and to sell out now, especially with the drops we've had, especially if you started from the beginning, you're still feeling a loss at this point. You haven't recouped what you need. One thing if you're leaving tomorrow out of work and you're retiring, another thing if you still have that 10-year space to go.
Yeah, and the other point on there that really jumps out to me is the seeing order and data where it doesn't exist. That's how many quote unquote investing schemes have you, not schemes, but framework, let's go with that, have come out throughout the years that they always work until they don't.
Exactly.
And and that's where that really comes into play. There is that you're taking something and you're going off of this past performance.
Yep.
And trying to project that into the future. Now, obviously, a lot of what we do is try to make sense of where we're at, but always with that in mind that this time it's different.
Well, it is. And I mean, the bottom line, it's not about the investment that you're doing. It's about the individual that's investing, what your needs are, goals are, risks are. That's what comes into play. And that's sort of what leads to the strategies that Rob and I are able to come up with.
Yeah. And I would say, too, that overconfidence, that always tends to, I think, happen at the peak of the market. For me, I've always kind of seen that. That's whenever you've got just like you kind of said, the water cooler talk, my neighbor's brother, sister's cousin's, son, put his own thing together and, he was up, 30% or 35% or 50% or whatever it might be. Well, in the market at the same time was up 30%. Right. There probably wasn't a whole lot of skill. It was, again, to use Mr. Buffett and one of his, a rising tide lifts all the boats.
Exactly.
And so sometimes you get lucky there. Going off of that, then you're kind of thinking about how the waves of this roll. So now we move into then blind love, which is where, we've gotten overconfident with something. We've made a pick. We've done something, bought something, and now we've gotten so emotionally attached to it.
And run.
Exactly. Yes, a very good example from back in the .com, the 2000, 2001, 2002 bear market.
Yep.
That we went through. That was,
I had a lot of clients hold on to it, rode all the way to the bottom, and got nothing at the end. So.
Yeah, well, and of course, again, Enron is an interesting example in that when you're cooking the books, that's it's kind of hard to make real decisions there also. But for the most part, I think we see this happen a lot of times. This is the whole thing of I think I've always heard this of, well, it was, and I saw this a lot in the real estate crisis.
Yes.
Well, my house was worth $450,000. Now the market on it is only $200,000. So I'm going to wait until it gets back to $450,000 before I do anything. And you just kind of sit there and scratch your head and like, well, yeah, it got there, but you realize that you're talking about almost 100% return on your house. Historically speaking, even if we get a 5% rate of return on real estate going forward, or even 7% to be generous, it's going to take you 10 to 12 years to get back to where you were.
Exactly.
And you're going to wait to make a decision based on that. And it's that whole thought of what something once was, and not being able to really kind of rationalize where it's at now.
It really is setting the limits for yourself on the down and the upside. When it comes to investing, you have to really look at it from that approach. You can't stay in blindly or follow it blindly. You sort of have to really be logical about it, understand what you're trying to get out of it. And sometimes we miss and sometimes we hit. And that's the whole point of the market.
Yeah. So, from that point, then we move into selective memory, which I think I've been accused of this in my personal life many, many times. But
only when you're trying to prove a point, Rob.
But this is where kind of framing this one. This is where we kind of playing into the overconfidence side of things. But this is where we remember all the winners, but somehow we forget all those losers that are along the way there too.
That sounds like a Michael Jordan quote. Yeah, he everybody remembers the shots he made, not the shots he's missed. He's missed so many more than he's made. So
yeah, and speaking of Jordan, that was always the one interesting Nike commercial that he came out with of, whenever you had his voice in the background voicing over exactly how many shots he did miss, how many game-winning shots he missed, how many times he'd been presented with whatever and it didn't come through.
Perfect analogy. That's what people remember. They don't remember the losers; they remember the winners.
But so that you kind of take that's obviously a group think, because we all think of Jordan, and obviously I'll probably get some flack for this one, as the greatest player of all time.
I would have to agree, but we're showing our age right now, though.
So don't hit us too hard with too many things there as far as that goes, but we'll give it. He's definitely one of the greatest of all time.
That'll be another webinar we could debate. We'll go
but when we're looking at, that's the group example, I think, of selective memory there, of forgetting exactly how many times somebody Jordan did fail. In our investing world, we're looking at it here, and like I said, you might remember that time that you picked XYZ stock and it went from and it doubled or tripled. But you've forgotten about the other 10 things that you picked that may have been down 1 or 2 or 5% or something like that, or even more greater than that you forget about all those things. And so you're not looking at it from a global perspective there. And then getting into that, talking about thinking in extremes. And I think especially nowadays, we see a good bit of this. I know I have.
Well, I always tell people this when they come into investing and they're looking to just swing for the fences. I said, you'd have a better shot going to Vegas for dinner and the show, because that's what happens in Vegas, right? You go there with the hopes of winning all this money, and the end of it, really what you get is a couple tokens and a free hotel night stay, and you can go down to the buffet and enjoy the food. And sort of, I'm not saying it's that extreme with the markets, obviously, but the whole point, one of the first things we say to people is there's no guarantees in the market. It's one of those things where, yes, there's an opportunity for growth, but at the same time, as we've seen here recently, there's also opportunity for losses.
Yeah. And in this case too, when we're talking about, kind of extreme thinking, it's that whole thing too, that, if something's likely to happen, I mean, it's dead set, it's going to happen. But if there's a chance that it might not, well, then it's just not going to happen at all. And it's completely discounted there at that point in time. And then we get into loss aversion. This one, my goodness gracious, we deal with this.
This is when everybody wakes up. When times are good, everybody's happy. We don't get many phone calls, no pets on the backs or anything like that. This is when we get the phone calls, which for the past month, that's pretty much all Rob and I have been doing.
Yeah. And, loss aversion, it's been documented many, many times over, whenever in that first point there, when it talks about the feeling of losing a dollar, has a far greater impact on us than gaining a dollar. I mean, there's been studies that have been done, even with off of coin flips, and because coin flip mathematical odds say it's 50-50. And again, we could even get back to our earlier thing of looking for patterns there, but coin flips, law of large numbers, easy for me to say, says that it's going to be 50-50. It's either going to be heads or tails. And there was one particular study done on loss aversion where they said, if it comes up heads, we'll give you $2. If it comes up tails, you have to give us $1. Are you willing to do that? And the vast majority of people wouldn't do it.
That's true.
And I mean, mathematically speaking, again, this is back to what I was talking about as far as when we look at it.
Yeah, I think the coin lands on heads more than 50% of the time. So actually, if you took that bet, you still come out ahead.
You just totally blew my thing out of the water, John. But no, you think back to like what we were talking about in the beginning of, how we look at things, and when we're evaluating things, I would tell a client, no, I'll do that all day long. I mean, because if it's 50-50 and you have a 50% chance of getting double of what you would ever lose, why wouldn't you do that? However, our natural kind of lizard brain instinct on the whole thing says, no, I don't want to lose what I've got.
My wife would say no.
She would, yeah,
She would say no.
and most people would.
Yep.
So she's not alone in that one. And but what happens off of that, then the reason why we're so loss averse is that emotional response to losing that comes into play there. And so in that, we want to do everything we possibly can not to lose what we've got, rather than risk something and putting something out there.
Exactly.
And another one that comes in, it's very, I think, top of mind, very topical for this point in time, is short-term bias. Otherwise known as recency bias. Has a couple other names that go along with that. But that's basically talking about that's what's just happened carries far more weight than everything, the rest of the sample size that's out there.
Absolutely. I mean, like we were talking about the other day, Rob, how people watching the news today don't realize the news they're getting today, stuff that they're acting on, is 2 weeks old, in a sense, with the market and how it affects, because the market's an everyday thing. And a lot of the news gets stuck on a topic for a little while, especially with the pandemic that we have right now. And it's unprecedented. It's something we haven't been through since, I think we talked about this in 1917 with the Spanish flu. So, and the markets are so much bigger today, and it's a global economy more so than just our own country, that the effect is seen obviously a lot larger.
Yeah. And like I said, too, it's one of those, whenever you kind of frame it in terms of guess what? We were up 30% last year. That's old news at this point in time. Hey, we were hitting new highs as of, February 12th. That doesn't matter now either.
Yes,
what matters is everything that's happened in here and from the end of February through the market. And don't get me wrong, I'm not trying to minimize the current situation, but I'm also saying that we have to be able to put that in context with a much broader, much bigger appeal out there of this too shall pass.
Exactly. I mean, if you go back in history with the Dow and look at where it was in 1932, the bottom of the Great Depression, and where we've come today, and even if you broke it down to 10-year intervals, you'd see the average of returns more than the losses. So over time, it's sort of what you have to do. It's time in, it's not timing.
Yeah. And let's talk to, we started to talk about Great Depression before, but I think it would probably be instructive to kind of lay out for everybody why this is different this time, because as I think we made reference to, the chart pattern looks very similar, with the very, the very steep drop in 29, and the way that the market handled from there. But can you speak a little bit too, in terms of, structurally speaking, what's different now than what happened back in the Great Depression?
Well, I mean, the first thing is it's a global economy now. Everything's run by the world. It's not run by our country. I think in the Great Depression, it was just U.S. at that time, and that's really where the hard hit came. On nothing that's ever been seen like that before, and they had to come up with a lot of new plans to go ahead and try to get things back where it needed to be. We look at today where things are driven globally. So this isn't just affecting us, it's affecting the world, obviously. And even our economy being as slow as it is affects the world, because we are probably 85% of the buying of the world when it comes to goods that are being made in China and other countries. So much different this time around, because I think on the scale that we're at, that's where you'll see the quickness in response. I mean, if you think about what we've done, having sort of the roadwork set for what happened in 2008 with the crisis, the Fed is definitely on top of what it is going to be done, to where if and when this virus sort of subsides, or we see a cure come out, or a vaccine, the markets, I think, will rebound pretty quick. And at the same time, I think the economy will follow, obviously, because with the rates being as low as they are, that'll get people out to spend more money.
Yeah. And it's funny you talk about the globalization now. And I think back to classic movie, Ferris Bueller's Day Off, with Ben Stein playing who just so happened to be quite the policy advisor himself, and student of Great Depression. The line in there of, if you remember, whenever they were showing the class and talking about what was one of the things that we did wrong, which was the Smoot-Hawley Tariff Act, which sunk us deeper in depression at that point in time. We're not going to do that. We're not going to go hide from the rest of the world and try to insulate this. You touched on it too, in terms of the Federal Reserve and their kind of their stance that they've taken, handling this monetarily. What happened in the Great Depression? We actually raised interest rates during that period of time. Which, if you understand any the quick thing with that is, you raise interest rates, you're taking money away, which means that you're not having as much liquidity out there. The Fed, from this stand, in the financial crisis, acted probably a little slower than what they probably should have. But then again, they were building something from nothing. This time it was a matter of, pulling all those things off the shelf, dusting them off, kind of updating them a little bit, and have really just, opened the taps as far as liquidity goes. So we're not going to see that happen here.
Definitely not. No lag there.
As far as that's concerned. And then you look at it also fiscally, fiscally, with the CARES Act that's been passed.
Yep.
And I think it'd probably make sense for us to talk a little bit about that right now.
No, absolutely. With that, it definitely allows anybody with retirement plans that are over the age of 70 who've been drawing their RMDs to not take them this year, which, let's face it, I'd say there's probably 50-60% of my clients who don't really even want it, but they have to take it. So having a year where you can sort of take the time off of that, it's not a bad deal to be able to keep some of that liquidity for yourself, not knowing where things might go in the future.
Yeah, and then you look at the stimulus checks.
Yep. $1,200 each individual.
$1,200 for individual, $500 per child.
Yep.
It's not cheap, obviously, and it's taxpayer money, and it has to be paid back at some point in time. But that's one of the fiscal responses that has made some sense. The propping up of unemployment benefits. The additional $600
Absolutely.
Per
small
week.
Business loans as well to be able to pay.
The payroll, the paycheck protection.
Payroll protection. Yep.
I mean, that program. I think if it's not close to being tapped out, it's.
I think they say it's going to be tapped out by June, and they'll need more money by then.
I mean, and the subscription that happened. I mean, obviously, Wells Fargo is taking some heat as far as their $10 billion allocation was gone over the weekend. Bank of America, I know, like within hours of whenever it opened, had 10% of it.
Crazy.
That they were talking, they had applications for.
Yep.
Could it be run smoother? Yes, but it's happened much quicker than anything that we've ever seen before. And so, and that was obviously a very good bipartisan coming together to really try to, recognize the seriousness of what's going on out there. But also, I think that's reflected in the market results right now.
It is. I think some of the confidence is there, showing that when we do start seeing some light at the end of the tunnel, which from the talks of all the professionals that are out there right now is within the next week and a half, 2 weeks, maybe we'll start seeing some things level off and drop. If that does happen, then I think we'll see a lot more confidence going forward. Yeah,
I agree. And just to get back into kind of our behavioral part here, not our short-term bias or anything, but another word that's out there a lot right now, which
Absolutely.
Is herding, which we've heard about in terms of herd immunity. This is a little bit different here as far as what this is herding, but this is basically when you follow the crowd.
This is sort of like a virus too, I would have to say.
Yes. Very true. And the last point on there, heavily influenced by the media.
Absolutely.
It's that feeling that, the headlines are what, how the media outlets make money. If they don't have people clicking on stuff, they're not going to make any money.
Well, I mean, I think we can all remember back in the times where news was more so to get people the truth so they can make educated decisions. And that's sort of what Rob and I do every day. But I think media that you see now today, the way they make money and how the organizations make money is by ratings. So a lot of it is more so entertainment based. And again, they sensationalize a lot of things just to get the viewership up to where they can make the money that they need to make.
Yeah, and it's I even look at it in terms of CNBC, even in good times.
Yep.
I try to encourage people. You can watch it, but watch it as entertainment.
Exactly.
Don't watch it as a way to really understand. Yes, they might be talking about what's going on at this very minute. But as far as an investment strategy goes, a long-term investment strategy goes, that's again one of my, my analogy of the escalator and the yo-yo.
Yep.
All right. If you're on an up escalator, you have a person on it and they have a yo-yo. Do you watch the yo-yo or do you watch the person, trending up the escalator? We want to focus on the escalator. We don't want to focus on the yo-yo. But it's fine, and it does provide some financial education. I'm not trying to completely bash the whole thing, but you can't just take those things and make rash decisions.
Exactly. I mean, you think about the decisions as important as a surgery. If your doctor told you needed surgery tomorrow, you're probably going to go out and get a second and third opinion. And I would say the same thing. Anybody you're talking to now, whether it be coming from the media, a friend or family, make sure you bounce it off a professional, and maybe not even just one, but one or two, maybe three, to get a really good idea of what you're trying to do. Yeah,
absolutely. And especially too in today's kind of hyper connected world, or virtually connected world, I guess is a good way to put it. If you think about Twitter, which I don't know if I have Twitter, but it might be cool, it might not, I don't know, but But you think about how the nature of Twitter, which is, used to be 140 characters or less. Obviously, they've expanded that now, but it was very short. Medium, very good for forwarding links and getting instant responses and things like that. But you can get people all going one way that might be completely wrong at the same time too.
It's true.
It's being careful about where you're looking at that. And we talked about kind of the market fluctuations and how we deal with that, and how our brains work in that. And we talked before about seeing patterns where they don't necessarily exist, and we tend to have that happen. And this happens, I think, in our lives a lot of times. We're forecasting something, we forecast in a straight line. And life doesn't work that way. It's a lot of the yo-yos again.
Well, you think of the human biorhythm. There's some days you're a little depressed, there's some days you're really happy, and in the middle is just the neutral. And the human biorhythm goes up and down every day, just like the market. So.
Yeah, and so if you look at here, so if yesterday we were lower and today we're higher, well, our natural inclination is that, well, guess what? Then tomorrow it should be higher too. Yep. It doesn't necessarily work that way. That's not how that goes. And we look for a trend sometimes that's just not there. And as you can kind of see there, yes, tomorrow might be up, might be sideways, might be down. You can't really make a real rational decision off of that. And again, when we get into the kind of the periods like we've gone through here, where we had down, 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 the natural inclination on that one is to say, well, guess what? We're going to be down tomorrow too. And again, it really doesn't make a difference. It could be one of the three ways, but like I said, our natural inclination is we're going to continue on this trend downward at that point. And so we talked about the media, and I don't think we're here to bash media by any stretch. It's the blessing and the curse of the world that we live in now.
True statement.
And I know whenever I started in this I started March 18th of 1993.
Wow. I remember December 27th, 2005.
Yeah, I remember because it was the day after St. Patrick's Day.
2 days after Christmas.
And so it was a great time to start a new job, I got to tell you.
Not a bad deal. Merry Christmas.
Not a good move on my part, was it? But back then, it was you didn't have a CNBC like you do nowadays. No. You didn't have the availability of information out there on the internet is far greater than the information that we even had coming across our desktops.
Does anybody own encyclopedias anymore? Technology has definitely taken over. Like you said, it's a blessing and a curse in the same note.
Yeah, but when you look at the different media and you see kind of the things that go on out there, it plays into the everybody's psyche. And I don't care who you are, it's going to have an effect of what information you're taking in. But even with that, we get into whenever we mail out statements, and we've talked about this in some of our strategy, is that when we're talking to people, in the midst of whenever the turmoil really kicked in, it was people were kind of yeah, I understand, I get it, I'm fine, but whenever they get their statement,
the first statement showing the losses is always a tough one. Whenever
you put that 10 or 15% down into dollars and cents, it has a little bit different effect on everybody.
Definitely.
And then obviously, I think you touched on pretty well too, the kind of the cocktail chatter, the water cooler, you hear it from other people and you take that as kind of gospel at that point. And we talked about, these are kind of our steps that we've talked about here, and putting them kind of on that wave, if you will, in terms of you're overconfident near the peak. And then as we're coming off of that peak, the blind love kicks in, and that's you're going to hold on to something, hold on to that house just because it used to be worth something. Then by the time that you bottom out, which is you throw your hands up in the air and say, I just want to sell it off.
I don't want to lose anymore.
Yeah. And then you get into the fear of loss that comes into play, and it's like, well, I'm going to wait for it to get better. Yep. And you stay in cash all the way up until you start buying, things improve, you start buying again, and then we go right back again to the other side there. And so that's kind of the roller coaster that we're trying to talk about here, and trying to really kind of balance out in terms of how do we make these decisions and what's a better way, what's a better approach. And it's not denying that those things exist.
Absolutely. I mean, again, it really comes down to the individual. And I think a lot of people don't realize that. It's hard to listen to a family member or anybody else tell you how to invest, because everybody's needs, risks, time levels, things like that, assets are different. So it definitely takes an individual plan.
Yeah. And so what we want to do is, like I said, we acknowledge those things and acknowledge those steps, but we want to be able to put now an actual plan in place in terms of, okay, what do we do now? I know where I'm at. I know what my natural inclination says to do, but what does my rationally thought out plan tell me that I should do?
Exactly.
And so in this case, if we're kind of taking this same roller coaster, whenever we get up to those peaks, which we never really know when the peak is, but we know after we've been up for a while what things look like. That's the time whenever you review your allocation at that point. And you say, you know what, I was a 70% stock, 30% bond investor. My stock part has grown to now where I'm really 80% stock, 20% bond. It probably makes sense for me to do a little bit of rebalancing here and bring myself back to where I was, and we call that kind of harvesting your winners.
Yep.
And allowing yourself to rebalance and to help keep what you've got. Unfortunately, again, it goes against human nature. That's that overconfidence of things that, well, I'm going to let that run for a little bit longer.
Yeah, I mean, bottom line, there are definitely a lot of investments out there now that do that automatically. But if not, it's definitely something you want to attain. If as long as your profile is the same, nothing's changed in your current day, you definitely want to make sure you keep things whole to what your profile says you want to be.
Yeah. And so then to kind of speak to, their next step in there would have been blind love, which is where we were, really kind of quote unquote married to something. This is, again, where you're putting that discipline process into here. And so even after we've kind of peaked and we're on a little bit of a downslope there, we continue to stay the course. And then whenever we reach into that trough, into the valley, into the whatever it
might be, right?
Whatever that whatever word you want to, ominous word you want to call it there, that's the time. The name to all of this is buy low and sell high.
Yep.
Last I checked, right?
I think you're right, Rob.
Isn't that what we're here for? And what we know is that if you extend that time horizon out, your chances of doing that are very good. It's whenever you try to start timing it and trying to shorten those cycles down, trying to, look at all the many get rich quick things that have popped up throughout the years.
Pyramid scandals. Think about that, where you go ahead and buy into this certain product. You're one of the team members. You're at the top of the pyramid, and everybody below feeds you. And if you get into the bottom, if you stay long enough, you'll eventually get to the top, and you'll make even that much more money back. Last time I checked, they're against the law now, but people still do them. I still see a lot of those things sort of go on where any place where you have to spend money before you make it, unless it's real estate, I really can't think of too many other things that would really lead down that path.
Yeah, I always go off of the old thing that my mom and grandma and grandfather always taught me, which is, seems too good to be true. It probably is.
Well, then the other famous one, right? If your friend did it, would you do it too? Watch out for that.
I always ignored that advice. So now we've reached kind of our trough, and we've got this discipline plan in place. We continue to buy on the upward slope there, and so I think what we're talking about here is it's a discipline process. There is a process, which is the most important part to it, but it's also we reevaluate this process throughout the entire way.
Well, I think the biggest thing too, a lot of people sometimes, especially in the cautious times when people are keeping a lot of liquidity and keeping a lot of cash on the side, you think about the average, let's just say the average money market rate's 0.5%. $100,000, we're looking roughly $500 a year. Yeah. Doing the math on that, if inflation on average is 3 to 5%, a lot of people think, I'm not losing money if I keep my money in savings. Well, over time, if you did that for 10 years, you've just lost roughly 30% of your buying power of being able to keep up with what the cost of goods are that day. Yeah. So,
it's one thing to keep liquidity on hand for rainy day, for just in case, or for a specific purpose.
Cover yourself in times like this. I mean, where you might need access to cash, but having an overabundance definitely could be a downfall as well.
But and just like you said, I mean, if inflation is running 2% and you're in something that's paying 1%, what you've done is you basically guaranteed yourself a 1% loss.
A loss each year, right? I mean, we just talked about how loss hurts. Loss is one of the emotional things that definitely stays on your memory a little bit more.
And that's true. And that's really kind of reframing exactly what that loss is, and thinking about it from that standpoint. Yes, your statement balance stays the same. However, does that $100,000 today, if it grows to $105,000, 5 years from now, but yet it takes $110,000 to buy the same basket of goods.
Yep.
That's it, but that's very hard to quantify, and it doesn't show up on a statement anywhere. But it's a very insidious force that's out there that happens. I don't mean to make it sound like the dark side or anything
Definitely
like
not.
that. But still, again, this is where the discipline comes into play. And it's funny because I know we talk about loss aversion. I know that you've probably seen it too, that you have people that have been in cash since the Great Recession.
Yep.
Up until now. And you kind of look at it and you're like, if you haven't done anything before now is probably not the time to go doing something at that point in time. If you've gone 12 years with the interest rate environment that we were in for 12 years and didn't do anything, then you might want to fight against your instincts there.
Better to stick probably on the bank side, CDs, credit union side, CDs, money markets, things like that.
But and then talking about this and what the effect is. This is from 2016. I'm not sure why we picked that year exactly, but we did. But the S&P 500 that year average return is about 12%. The average investor, however, just a little over 7.25%. And that just goes to show, how all those things, what that effect is on us. I mean, that's cutting out 4%, almost 5% from a very good year. And that's the return that was missed out on there. And really, then that's where the role of an advisor comes into play, is to help be that neutral party that says, okay, well, I hear what you're telling me right now, but what's changed in your life? What have your goals changed? Has your income changed? Has your personal situation, has anything changed there? Or is this just an outside force, which is the market, but none of us control it, on a day-to-day basis. And so, we've known that this is going to happen. And so I think we need to stick to this plan that we had laid out here 3, 6, 9 months, a year ago, 2 years ago, whatever it might be.
No, absolutely. Again, it really does come down to finding that person that can definitely make you look at it, take a more logical approach to the whole deal. Because bottom line, most of the times we're talking long term here.
Yeah. So, then taking that behavioral finance part of that and, being able to say, okay, let's eliminate those negative emotions, those things that we know can cost us 4 or 5% in terms of an overall return. And let's refocus those efforts here. And so let's put that back into it. It's taking that emotion out of that decision making and making what the quote unquote knee jerk reactions. And then again, putting a plan of action in place to go forward from there. Focusing on those long-term goals.
Absolutely.
On hey, we want to retire in 5 years. Hey, we're retired now and we want to have X number of dollars for to be able to spend. Whatever that might be, it's being able to then come back at that logically again. So obviously, in a bear market, it's we want to our good plan of action. Understand those emotions, understand the role that they are, understand that you're not going to change them.
Yeah, and what Rob and I've been talking about, number 2 there, review goals and facts. Really stick to the facts. Be logical about it. If you need access to funds, then we definitely want to make sure you have access to that. But at the same time, if you don't, all the more reason to leave it in, as long as it's fitting your existing goals.
Yeah. And then obviously, you're going to leverage strategies, and that's. I know for me with clients, I usually tell them, look, my job in this is to put a good plan together and for us to have positive results. But if I can keep you from making 1 or 2 big mistakes a year, I've more than earned my keep at that point in time. And that's really kind of my job, is to act as that logical filter, that to take all that stuff. And, I would encourage anybody, find somebody to talk to, before you go, and don't try to go it alone. I mean, I think if anything about our current situation has proven that with social distancing also comes social isolation. And what that feels like. I mean, I'm one, believe me, who loves to, shut down the engine, recharge the batteries, that thing from time to time. But I think we've all gotten a pretty big dose of that right now.
After a week or 2 of that, it's you're sort of jumping, like we were jumping at the bits just to get out here and do this webinar today.
Yeah.
So
and you learn then exactly how that affects the decisions that you make.
Yep.
And so that's why it's always interesting to be able to talk to somebody about this and say, hey, this is what I'm thinking. and you kind of take it from there. Or if you don't have a clue, then go talk to somebody, and if they make sense and they kind of speak your language and that type of thing, then that's a good way to put that into action as well. Obviously, the way to make bad decisions in this is to follow, like I said, kind of that lizard brain that we all have.
Yep.
With that, we talked before about our animals, and so we talk about ostriches and wolves here, and an ostrich obviously makes three main ways that they make decisions, which is they either sell everything, it's just chuck it all, I don't want to even deal with it anymore. When we say do absolutely nothing, that doesn't mean that you don't pay attention. It doesn't mean that you don't review allocations and then not act on it. It just means that you just try to ignore it like it's not even there. And then obviously from those, then you want to try to hit the reset button and make wholesale changes to restart everything over again. All three of them are not a real effective strategy there, I don't think.
No, I mean, knowledge is power. Obviously, making sure you have what you need to make that decision for yourself is key.
And then we have the wolf, which is the other extreme, which is the one who acts first and asks questions later. Yep. And again, it's another natural kind of human response to things that go on. It's this happened to me, and now I'm going to lash out at it. And it might not even be at the right source of everything, but I'm just going to do that. And again, they tend to have the same, three things that they do, which of selling everything. It's just, and then you have to start back over again from somewhere.
Well, it's one of the things you sort of kick into, right? In a market cycle, if you're looking at a 10-year cycle, there's going to be 3 years you love your advisor, 3 years you hate your advisor, and 4 years that you're just okay. And it's just the market cycle. There's really, I guess that's probably the simplest I can put it.
That's exactly it. So, and I should back up and say that obviously we don't have pandas, but what we're really striving for is to kind of play off of your analogy of the racehorse.
Yep.
The racehorse with blinders on it.
Yeah, we're talking about the reason why they put blinders on horses so they could look straight in front of them and try to catch up with the horse in front. Because if they sometimes look to the sides, it could get them spooked or maybe get them off course. So the biggest thing in times like these, especially if you don't need access to the funds, and I can't really say that enough. If you do not need access, the best thing you do is throw the blinders on, look forward to what your plan is in the future. And if that plan changes or deviates, that's when you'd want to sit down with somebody to talk about that.
Yeah. And that's really the biggest thing here. And that's kind of going into when we talk about reviewing your goals, reviewing the facts, is looking at how should it have behaved? Right. How did it behave? Historically speaking, how has it behaved? Where are we at in terms of that? And like I said, then taking into account your goals and objectives. Has that changed? It's really doing that kind of that pragmatic checklist, I guess, throughout all of that, and having that framework then to make decisions off of, rather than just, well, this sucks and I want to do something different.
Exactly. And we send one of those out every single year too, for be able to tell us what's changed or anything drastic that's happened. If not, we usually say stay the course. If so, we would definitely set some time to come on in and talk about that to make sure we can change the strategies appropriately.
Yeah. And we talked about having the plan, talked about reviewing the asset allocation, obviously looking out there at, new products. I mean, it's amazing, having done this, we've both been in this for 20 something years. The things that we can deal now that we didn't have before, exchange traded funds with, risk control and things of that nature, things that didn't, really, we couldn't do before. And so it's really, working with somebody who's, staying abreast of those things, I think is important too.
No, absolutely. I mean, investments are complicated. We do this every day. That's why we sort of have the sense that we do. Just like anybody else in a different profession, I couldn't do your job either as well as you do. So,
Yep. So with that, I think we've talked about this, kind of the three keys there, look at your allocation. We talked about that in terms of, are you out of balance? How do you get back into balance again? And it's not waiting, until bad times hit to do that. It's a constant monitoring fact there. And these are some things. And if you want a copy of this, just email us and we'll be happy to send a copy that we actually have a framework to do this review off of. If you want to do it yourself, if you want to come in and sit down with us, we'd be happy to help you with it as well too. but kind of the managing your risk and looking at options to manage your risk. Obviously you have to grow, but your emotional side of you wants to control risk. So how do we balance those things out? Do we need income now, or do we need to have income in the future? How do we isolate those things? And so those are some considerations that we have to throw into there as well. Then looking at, later on, does it make sense to use certain types of products? And don't want to get too far into the weeds as far as that's concerned. But, and then, like I said, really having that plan and having it in writing is actually really important. I mean, there's been study after study after study has been done that shows that the ones who have a written plan have far more investment success and feel better about them, and all those, whatever measure you want to quantify it on, than those who don't.
Now the famous saying, right? People don't plan to fail; they fail to plan. Yeah. So having a plan with anything, from investments to savings goals to education for the kids. I mean, whatever it might be, putting it down on paper, see it, say it, write it, is how you remember it and how you come closer to attaining your goals.
Well, and it's that thing I know, and again, we talked about, when we started, and I remember the guy that I worked for whenever I first started in this business, we did a lot of seminars, and one of his lines from one of his seminars, and this is pre-MapQuest, I'm really dating myself now, pre-Waze, which I'm a Wazer, but I'm a Mazer and a Wazer, but he would say, if you wanted to get from where we are right now to Barstow, California, would you just launch off and go and not look to see how you're going to get there? I mean, why do you do that with your money? Why do you just throw it out there and say, I want to make as much as possible? Well, how do you know when you're successful? How do you know how do you know if you're underperforming? How do you know if you're overperforming? If you have no plan in place, you have nothing to measure it off of.
Well, what's even funnier is I was reading an article the other day about people planning for their financial future, whether it be retirement, whatever it might be, at the same time planning for vacation. And people spend more time planning a vacation for a week than they do the rest of their lives. And that baffled me. So
it's crazy.
Definitely wanting to get together with somebody, a professional, and being able to put together a plan. And again, there's no cost on anything we do. Partnering with a credit union, it's a free service we offer all memberships.
So, and then obviously looking at, protecting your savings. And I'm going backward. So my favorite time, the Q&A portion of our program. So we actually do have a couple questions here from our listening audience, which thank you very much for attending, by the way. But first question we have is, are there any indices or indicators that you can use to tell when the market's about to turn so you can make the appropriate decision to sell or buy? And if not, is there a trend I should be monitoring to see a key variation to the answer above?
Charts, maps, guidance, and everything. If you're a savvy investor, you probably already know where to go look. If you're not, the best advice I can give is definitely to sit down with a professional, somebody who could definitely maybe point out, educate you on how to look at that, maybe, and then go from there.
Yeah, and I think too with that, I mean, obviously there are some key, valuation tools that we look at, in terms of, the price to earnings ratio. In other words, how much are we paying for every dollars of earnings, that's out there, and you can look at it both from a individual security level to a market level. And when the S&P, when the price to earnings ratio gets elevated, we tend to think of it as kind of expensive at that point in time. Doesn't necessarily mean it's going to turn around at that point. But again, putting that discipline in place to say, yeah, you know what, it's probably a good time to rebalance right about now, and to take some money from our winners and move it over to the side, or move it over to our losers, something like that.
Right.
In terms of trends, and especially to kind of put it into context with what we're going through today. Obviously what we're going through today is a health related issue. This wasn't a market, a structural kind of thing.
No, economy was strong. Everything was where it needed to be.
And we know that, markets tend to be leading indicators. And even the great financial crisis, the market turned positive 6 to 7 months before the economy as a whole began to kind of show a lot of those green shoots, was kind of the term back then. But, I think in terms of this current pandemic, I mean, obviously, I think we need to see, like we talked about before, we need to see a treatment of some sort, easy for me to say again. Then I think you see, kind of that vaccine part that comes into play there too. The vaccines, obviously, we're talking 12 to 18 months, and we're not going to be able to continue on, that long before something's going to happen. But I think that, from a medical perspective, people are pretty innovative nowadays. And so I think we'll see some breakthroughs come through on some things.
I'd agree with that too. And I think, Rob, you came in and we were chatting a little bit this afternoon before the webinar with the new numbers that the government's sort of come up with, the administration saying where we probably hit our peak of 60,000 deaths in the United States from this. And if you think back to 2017, 2018, or I'm sorry, 2016, 2017, I think the flu had 60,000 deaths. So again, not wanting to lessen what we're going through right now. Obviously, it's definitely highly contagious, lasts longer outside the body, a little more extreme when it comes to the respiratory things, stuff like that. So I'm not trying to make this little or light. But I think, again, being educated, making sure you're not a sky is falling chicken little individual where, that's all you're thinking about, seeing the sky fall. When when the sky's falling, you sort of look through the holes there and see what else might be on the other side. And that's sort of what we all have to try to bunker down and do.
Absolutely. Another question from our audience. So what is our opinion on investing in a cruise line company like a Carnival while it's cheaper?
You always want to buy low. That's what we've been talking about.
It's low.
It is definitely lower than when we started. But I mean, if you think that we've reached the bottom, or you don't think there'll be another decent sized drop, based off what the administration's saying, I guess my advice to you would be, based off what I've heard from the White House, they're talking the next week and a half, it being the most extreme as far as the biggest growth in deaths within the country. I would probably say that would have an effect on the markets as well, in a negative way. So that being said, my advice might be hold off for a week and a half too, and see what happens.
Yeah, and the cruise lines especially, since they weren't eligible under the CARES Act for much of the bailout, that not hate to use the word bailout, but much of the help, I guess, that came down, since they tend to be offshore, Panama, other countries. They're going to have to seek some help from somewhere else. Now, obviously, they still have some assets. But we've also seen big companies before that have lots of assets, General Motors, for example, that have gone through a tough time and declared bankruptcy. And what that does is it wipes out all of their equity shareholders. And so I'm very cautious right now about the cruise lines, I have to say. Not that I think that the cruise industry is going to go away, but as far as being an equity investor right now, it makes me a little leery. I would put it that way. And so obviously, as soon as I get my reassurance on that, it'll go shooting back up again. I think we've seen Carnival, they got an infusion from, I think it was from the Saudi sovereign wealth fund.
Yep.
But it's going to take a lot to keep them, for lack of a better word, afloat.
No pun.
Yeah. Well, there's a pun intended. So what's our advice for people wanting to purchase a house right now?
Well, if you are one of the lucky ones to still be able to work and have a normal working schedule, hours, income coming in, rates are at an all-time low. Now is the time, if you're going to finance anything, even though it's a scary time thinking about what may or may not happen with your job, it's an amazing time to go ahead and jump in and do that. I know purchasing a house as well, you do have opportunity to go ahead and purchase insurances that can actually pay your payments if, God forbid, something were to happen with your job. So there's things like that you can just do to set yourself up. But I would say absolutely, if you have a steady job and you think you're going to be keeping it, by all means, it would not hurt you to take advantage of the low rates right now.
No, I mean, with rates being as low as what they are, I mean, it's crazy. I mean, you're talking about 3%, and sometimes, for shorter term, 15-year mortgage with a 2-point-something.
Yeah, it's crazy.
So that's not a bad thing to do. But like you said, I mean, you also want to make sure you get into it that you have adequate emergency savings.
You need your down payment. Are you going to be okay with the P&I if you do not put the 20% down, things like that. But I mean, there's so many different options out there. And I know there's a lot of individuals within the credit union that can assist with that.
What's the difference between an annuity and a traditional IRA?
Well, I'll tell you what, traditional IRA is really not an investment vehicle. It is strictly an arrangement, an agreement you set up. It's called an individual retirement agreement. The way it works is you're able to put money in there for future needs within retirement. You put the money in, if you touch it before 59.5, you're penalized taking it out. After 59.5, there's no penalty. You just pay tax on whatever the growth might be on the traditional. As far as an annuity can actually go inside an IRA. Right. So an annuity would be an investment vehicle that would create wins or losses depending on how you invest or what type of annuity it is.
Yeah, I always describe it that, think of the IRA as kind of a bucket. that you can put lots of different things into, whether it be stocks, bonds, exchange traded funds, mutual funds, annuities, pretty much everything except for collectible art and life insurance. I think are kind of the two ones that you can't put in there. So you could have an annuity inside of a traditional IRA, and then even you can have an annuity outside of an IRA as well,
which can give you IRA-like tax deferment.
Yes, because it gives you again the tax deferred growth until age 59.5. The annuity, one advantage to the annuity is that you can convert that into a stream of income payments that you can't outlive. But like you said, I mean, it's one of those that we can kind of evaluate and say, is this the right thing for you? I mean,
there's hundreds of companies, thousands of different style of annuities. If you're not really sure what they are or how they work, definitely would benefit you to sit down and talk about those.
So another question, is this a good time to move my retirement to a long-term investment?
It depends how long you have to work. We always want to look long term. If you're a year away from retiring, I might not want to consider being too aggressive at this point because we can't recoup if there's still losses to be had. On the flip side of that, if we have, say, 5 years or longer, I wouldn't be afraid to go ahead and look at a long-term plan and maybe take a little more risk. Because let's face it, if you think that we can get back to where we were before all this happened, that alone is in a sense people breaking even that might have stayed in. You starting off now, having the opportunity for that growth is pretty huge.
Yeah, and the other thing there too is obviously the retirement is an important consideration, but it's also when you need to start taking income off of those assets.
Yep.
Yeah, because if it's one of those where between my pension and my Social Security.
Wait, you get pension?
I got the special plan. Say if you're a teacher in the Florida retirement system on the pension plan side, if your pension and Social Security is going to be more than adequate to pay for your monthly expenses, and you've got some retirement money saved up, probably is a good time.
Absolutely, an opportunity to invest and capture some of those too.
Yeah, not a bad time to look at that. But I mean, it's definitely a time to evaluate because again, we said you want to buy low, sell high. Whenever things are lower, it's not a bad time to at least consider that and to go through that evaluation process. Next question. How do I know who is the best investor to invest my money for a long-term investment?
Well, what it comes down to for me, I always tell people this, shop advisors like you'd shop anybody. I think you have to, first of all, trust the person you're with. And secondly, it's got to be convenient for you. But first has to be trust. Somebody you enjoy doing business with, somebody you trust to do the right thing. We obviously now, FINRA's passed laws in 2015 where we do have to act as fiduciaries when it comes to retirement money. I always laughed at that though, because there was a lot of advisors that got upset when that happened. Whether it be retirement money or non-retirement money, I always looked at that as I've always acted as a fiduciary where I'm putting you first before my family and how I get paid. So. Yeah.
Next question is, given the recent market loss, I was considering moving my 401k to a more conservative IRA, for example, in a Roth IRA savings account. But I was waiting for the market to go up, as it has here in the last week or so. Is now the time to transfer my 401k? I'd rather sell high. Also, how can I make sure that I'm getting the best rate possible in there if I do decide to go through with that?
Good question. That is one you definitely would want to sit down with somebody and talk about. Nothing we can really answer on a broad scale because, again, every individual is different. There's so many different things that come into play before we can give that type of advice.
Yeah. And I would say, too, that just like kind of what we talked about before, I mean, if you're moving out of something now, you might have a good reason for that. If you kind of had looked at something and got invested in something because back whenever things were going well, and now you're seeing what the downside could be, and it's not something that you can stomach, then I would say that, yes, it's probably a good time to reevaluate and maybe you need to become a little bit more conservative. I do think, though, that going from a market-based investment to like a Roth savings right now,
that's an extreme,
would be very tough because you think about how long it would take in order for you to break even. I mean, if you were down 10%, if your Roth savings account is going to pay you next to nothing right now because short-term rates are back down. The Fed has set those at next to zero. It would take a long time to recover if there's a loss in there at that point.
Well, I always like talking about rule of 72 and times like that too, where you can sort of divide into the number of 72. So say your average return in a Roth savings account is 1%, which is extremely high right now. Yeah. But say you're able to get the 1%. 1% into 72 is 72. That's how many years it would take to double whatever money you put in there. So if you were to put in 100,000 to get 200 out of it, you'd have to wait 72 years. So depending on what your goal is for your funds, I mean, I have some people that say they don't want to lose a dime and they don't care about what it makes. then a Roth savings would probably be okay. On the flip side of it, if you want to at least keep up with inflation, 3 to 5%, then there definitely has to be some other opportunity in there.
Yeah, it's about that understanding exactly what that decision is going to do, and kind of what the ramifications are, both good and bad, going forward. Another question about refinance, or actually this one is about we had one about purchasing before, and we have one about refinancing.
Okay.
So if we have somebody that has an interest rate right now of 4.99%, is now a good time to consider refinancing?
If the banks are open now, you should go. No, I'm sure there's some online applications with your institution that you do your banking with. I would suggest maybe jumping on there to get some information. You might even be able to put in an application to see what you qualify for. They can even probably go over rates, possibly give you an idea. I think if you go on the sites, they have the rates on the sites now too. Yeah. So yes, if you're a 4.9 and it's more than say $100,000, I would say absolutely you should probably strongly consider refinancing.
Yeah, and that's one that I definitely would encourage to reach out to somebody here within Addition. If you're a credit union member, somebody can definitely help you kind of walk through that in terms, because there's so many variables that can come into play there. There's, what the debt to income looks like. There's the, what the credit score looks like. There's the collateral itself, kind of the value of that and everything. So, but that's something that somebody can walk you through. And like I said, that's definitely worth exploring. But I mean, obviously we couldn't say absolutely go ahead and refinance right now. But I think it's now, if you're looking at it, if interest rates are lower right now
than 4.9,
then it's definitely worth exploring.
I refinanced mine, and I'll tell you, it was definitely seamless. They did a great job having everybody reach out, give me the information that I needed to be able to make that decision. So I would definitely, like Rob said, strongly suggest getting back with somebody with Addition.
Perfect. Well, this has been fun. I've enjoyed it.
It's been awesome. Rob, I always like hanging out with you.
I know. But hopefully, some of the things that we've shared, I think it came from a little bit different place than your typical kind of bear market, getting to some of the behavioral finances, understanding some of those emotions that we all deal with and all have to grapple with.
Well, me and you get emotional about this because we're passionate about what we do and helping people. So, I mean, bottom line, having the opportunity to come out and do this, thank you so much to Addition Financial.
Yeah.
Thank you, Rob and John. This concludes our presentation tonight. Check your inboxes for an email containing a link to tonight's recording, and thank you all again for joining us. Have a good night.